Welcome to Capital Advisors Group's Market Update, where in each webcast we give you a brief recap of recent market-related events and how they might impact investment decisions. I'm Anthony Cucinotta, Head of Trading at Capital Advisors Group, and today I'd like to discuss what I've seen in the markets over the last several weeks. It's been trying times for us all, to say the least. The global pandemic has had major impacts on society, impacting nearly every facet of the economy, and as you'd imagine, the financial markets were not immune. But like other facets of the economy, with help and aid from the federal government and the Federal Reserve, the markets have shown great resiliency through these trying times. So today I'd like to give you a brief recap of some key events and how they've affected the credit markets. Now, it's been well over a month since Fed Chairman Powell and the FOMC made a drastic move by cutting interest rates 100 basis points intermeeting. In his statement that Sunday evening, Powell recognized the impact and harm the coronavirus had globally. It was affecting communities and disrupting economic activity around the world. Now, while the timing being a Sunday was odd, I felt the message he sent that night was not. It was there that he set the precedent that the Federal Reserve would do anything in their power to help aid the public and the economy in any way possible. Now, while U.S. markets were closed at the time of the statement, the impact of the cut was seen almost immediately in trading overnight from Asia and Europe, as the Dow opened lower and closed down nearly 3,000 points lower from the previous business day's close. Also, at the time of the cut, we already see the impact this brutal virus had on other nations. The U.S. had just begun preparing itself for what would be our new norm, with states and communities issuing social distancing and stay-at-home advisories and school closings beginning to sprout out. So again, while the timing of the FOMC interest rate cut was a bit unexpected, the market was already anticipating such a move. Fed funds futures contracts, a tool used to gauge Fed activity, had already all but priced in a drastic rate cut. This anticipation, along with investors globally seeking the safety of U.S. government debt, led to lower yields weeks prior to the actual FOMC decision. Still, Treasury yields fell even further as investors began bracing themselves for the severity of the situation we were actually in. Now, the graph here illustrates the descent of one-month Treasury bills. You'll notice the actual descent occurred nearly 2 full weeks prior to the FOMC's decision. As you're all aware, the markets have been tested before. Once, nearly 2 decades ago during the terrorist attacks of 9/11, and again during the financial crisis in 2008. Now, while all these events are extremely different in nature, market reaction can tend to be somewhat predictable. Using past events as a guide, we fully expect to see yields on government debt fall and volatility in credit products begin to rise. However, because of the global magnitude and national uncertainty surrounding this particular event, it was hard to gauge exactly how the market would react and how long it would take for it to recover. As with nearly every short-term cash investor, liquidity and capital preservation are extremely important. Because of this, during any time of market stress, redemptions from money market mutual funds and short ETFs are common. So it wasn't a big surprise to see the massive selling from these short-term instruments, as investors preferred the safety of government debt over their credited counterparts. This partially explains a temporary drop of short-term Treasury yields into negative territory at the time of the cut. This unfortunately can cause dislocation in the market, meaning there's an imbalance between buyers and sellers. In this case, there were more sellers in the market than there were buyers. And naturally, due to the magnitude and uncertainty surrounding the virus effects in the economy and the nation in general, the dislocation at this particular time was extremely large. The graph here shows a spread widening on non-government investment products at the early stages of the nation's shutdown. You'll notice that the option-adjusted spread, which is simply the spread you would expect to pay over U.S. Treasuries for non-government securities, rose drastically after the FOMC's decision to cut rates. So again, while short-term Treasury yields were at or below zero, spreads on credit products began to widen out drastically. Again, this here is market dislocation. It was not a credit event. While funds were preparing themselves for redemptions by selling securities, most investors remained on the sidelines, not very eager to take on that extra supply. This can obviously put a strain on market prices and liquidity in general if not remedied quickly. However, as I mentioned before, and to their credit, the government and the Federal Reserve made it very clear they would do everything possible and in their power to help stabilize the markets and the economy. Now, the FOMC already had tools in their kit that were used during prior market disruptions, so the framework was already set. Now it was just a matter of deploying them. And not only did the FOMC utilize prior facilities that proved to work in the past, they also implemented and created newer facilities aimed to target issues specific to this particular location. I would like to highlight one program here, the Commercial Paper Funding Facility, and how it corrected some of the market dislocation at that time. As it sounds, the Commercial Paper Funding Facility, or CPFF for short, is aimed to alleviate stress in the commercial paper markets by offering funding to qualified issuers. Typically, during times of stress, when the Federal Reserve cuts interest rates, you'll see absolute yields on other short-term products like CP fall as well. But if you notice on the graph on the screen, similar to the OAS spread graph I referenced earlier, we started to see levels on commercial paper rise drastically. Again, this was due to market dislocations. Money funds who were major buyers of commercial paper were now sellers, and other short-term investors did little to pick up the slack. So while there was opportunity for yield, the preference for liquidity tipped the scale at this particular time. This caused a widening in CP rates, which not only causes stress for market values, but more importantly, puts strain on issuers looking for funding through the commercial paper markets. Now, the announcement of the CPFF helps the markets for very important reasons. One, it helps issuers receive the funding they might need to sustain operations and business activity by putting a ceiling or a cap on the funding rates that they would receive in the market. In this instance, the rate set by the FOMC was a spread of OIS plus 200 basis points, which was quickly reduced to 110 basis points, which only helped the issuers in the markets even more. By placing a ceiling on important vehicles like CP, you also help place ceilings on other potential investments like secondary corporates with similar maturities. To put it plainly, with CPFF in place, market participants began regaining confidence in the market, knowing there was a backstop from the federal government from qualified issuers. This in turn trickles down into other investment products, leading to less market dislocation and better liquidity throughout short-term investments. And this graph here highlights the spread tightening we saw in the markets shortly after the FOMC made their announcement to install some of these facilities. You'll see here that spreads began to widen out drastically shortly after the rate cut. I'd argue too that spreads actually widened even further as there was very little liquidity in the market at that time. But after these facilities were put in place, we began to see the markets normalize and become more efficient with bid-ask spreads tightening in further. The CPFF was just one of several facilities the Federal Reserve used to stabilize the markets. I want to truly commend this Fed because not only did they use a number of tools to address the specific issues, some old and some new, they did so promptly and they weren't afraid to tell the markets that they had more where that came from. This, in addition with the help from the U.S. government stimulus package, all helped calm the markets and the dislocation, leading to more efficient markets that we are seeing today. This concludes our first webcast of Market Update. If you'd like more information or have any questions, you can reach us at capitaladvisors.com or at info@capitaladvisors.com. Thank you.